Good morning and welcome to the Post-Monetary Policy Committee press briefing. The MPC of the Central Bank of Kenya met yesterday, the 8th of April 2026. And so today, as we customarily do, we have a briefing for you, the press and the public, led by the chair of the MPC, who's also the governor of the Central Bank of Kenya. As is usual, the governor will go through his presentation and then come back to take any questions or interventions you may have. If you'd like to do that, please come in through Slido. That's www.slido.com. Ensure that you include your name and institution as you ask your questions. And please note that we have realized that a lot of these questions sometimes tend to get answered during the presentation. So in case we don't come to you, likely that question has been handled in the governor's presentation. But for now, I'd like to introduce and welcome the governor of the Central Bank of Kenya, who is also the chair of the MPC, Dr. Kamau Thuge.
Good morning, everyone, and welcome to the post-MPC press briefing. The outline of my presentation covers the monetary policy decisions, the global economic developments and outlook, and then we move to the domestic economic developments and outlook, and finally a summary and the key takeaways. During this meeting on April 8th, 2026, the Monetary Policy Committee decided to maintain the central bank rate, the CBR, at 8.75%. In doing so, the MPC observed that the conflict in the Middle East has disrupted global supply chains, leading to significantly higher energy prices and heightened risks to global inflation and growth outlooks in the near term. But despite the expected upward pressure from high energy prices, Kenya's overall inflation is expected to remain within the target range in the near term, and this will be supported by appropriate monetary policy actions, the expected stability in food prices attributed to favorable weather conditions, and a broadly stable exchange rate. The committee also observed that central banks in the major economies have kept their policy rates unchanged as they assess the impact of the conflict in the Middle East on their inflation and growth outlooks. The average lending rates in the domestic market have continued to decline, while private sector credit growth has continued to improve. The MPC therefore concluded that the current monetary policy stance, with the central bank rates unchanged at 8.75%, remains appropriate to ensure that inflationary expectations remain anchored within the target range and that the exchange rate remains stable. Additionally, the MPC assessed that there is need to monitor any second-round effects of the recent increase in international oil prices on overall inflation. The MPC will closely monitor the impact of this policy decision, the evolution and impact of the conflict in the Middle East, as well as other developments in the global and domestic economies, and stands ready to take further action as necessary in line with its mandate. The committee will meet again in June of 2026. Starting with the global economic developments and outlook, the inflation is projected to increase in 2026, mainly driven by a sharp increase in energy prices and fertilizer costs due to supply chain disruptions, again attributed to the conflict in the Middle East. Using the March 2026 OECD interim economic outlook, although we normally do use the IMF World Economic Outlook, and looking also at some of the select countries, especially some of our major trading partners, the Eurozone inflation was at 2.1% in 2025, and now this is expected to increase to 2.6% because of this crisis. In regard to the United Kingdom, inflation was at 3.4% in 2025, and now this is expected to rise to 4%. For the United States, inflation in 2025 was 2.6% and now expected to rise to 4.2%. Looking at some individual major economies, on the left-hand side, you can see the headline inflation has remained well above the target, and this has been because of the stickiness in the core inflation, as you can see on the right-hand side. On the right-hand side, you can see that core inflation has remained well above the 2% that the central bank's target. In the case of the US, core inflation is at 2.5%, the Eurozone 2.3%, and the UK at 3.2%. And it is this core inflation that has really prevented the headline inflation from moving towards the 2%, the central bank's target. So, and one of the reasons why the actually headline inflation has been where it was in those countries was because oil prices had been low. However, the oil prices have now risen sharply and are quite volatile, again due to the supply disruptions and the elevated uncertainties attributed to the conflict in the Middle East. In addition to that, the global food inflation increased modestly in March of 2026. Before that, you can see that inflation was actually, global inflation, food inflation was actually negative 0.9, and as of March it has increased to 1%. And the reason for this is because edible oil price inflation has accelerated from 11.7% in February to 13.2%, whereas the cereals price inflation also has accelerated from minus 3.5 to 0.6% in March. In the case of sugar price continues to be 21% below the same period last year. However, between February and March, we've seen that the negative inflation is less, and all this combination of higher edible oil prices, higher cereals prices, and less negative inflation for sugar has contributed to an increase in overall global inflation from negative to positive. Turning to the global economic growth outlook prior to the conflict in the Middle East, global growth was projected to remain steady at 3.3% in 2026. But this is now expected to moderate due to the effects of higher inflation and reduced demand arising from the higher energy prices and elevated uncertainties. Again, just to highlight a few of the countries, in the case of the Eurozone, we see that growth in 2025 was 1.4%, and that this is expected to decelerate to 0.8% in 2026. In the case of the United Kingdom, growth was 1.3% in 2025, and this is also expected to decelerate to 0.7% in 2026. Whereas for the United States, growth was 2.1% and now is expected to be 2%. In regard to the global financial conditions, financial market conditions have tightened due to the elevated uncertainties, again from the conflict in the Middle East. We've seen equity prices decline, and we've also seen the Eurobond yields have risen, and we have given there the examples of a few selected African economies, and certainly for the EMDs, the emerging markets and developing markets economies, they now face higher yields as they access the international capital markets. So to summarize on global developments and outlook, the global inflation is projected to increase in 2026, mainly driven by higher energy and fertilizer costs. The central banks in the major economies have kept their policy rates unchanged as they assess the impact of the conflict in the Middle East on both inflation and growth outlooks. Global growth is projected to moderate in 2026 on account of the higher inflation and reduced demand attributed to higher energy prices and also elevated policy uncertainties. Global financial conditions have tightened as reflected in the decline in equity prices, the rise in Eurobond yields for EMDEs, and appreciation of the US dollar against major currencies. And this may restrict ability of EMDs to borrow in the international capital markets and leading to higher debt service costs and reduced capital inflows. Risks to the global growth outlook remain elevated due to the evolving conflict in the Middle East, elevated trade policy uncertainty, and weak global demands. Kenya's growth is expected to remain above the global average, above the EMD's average, and also sub-Saharan averages, mainly reflecting the resilience and diversified nature of our economy. Turning to the domestic economic developments and outlook, and starting with inflation. Again, this is a longer picture of the developments in headline inflation, starting from when the inflation was 5.1% and reached a peak of 9.6%. As you can see, since July of 2023, the inflation came in within our target range, just below the 7.5% upper bound, and has remained within the range since that time. And indeed, as of April 2024, it went below the midpoint, 5%, and has since that time remained below the midpoint, 5%. And as of March, we see this, the inflation had reached only 4.4%, although it was an increase from 4.3% the previous month. As I said, the overall inflation stood at 4.4% in March, again compared to 4.3%. You can see the dotted line, they're increasing to 4.4%. And the reason for this increase to 4.4 was due to an increase in non-core inflation, which rose from 10.1% to 10.8%. On the other hand, the core inflation remained unchanged at 2.1% in February and 2.1% in March. In terms of the drivers of core inflation, as I said, core inflation was stable in February and March, and this stability was supported by the lower prices of sugar and also maize flour, and this offset some of the increases in the transport inflation and also in the inflation of other items. So the core inflation remained at 2.1% in both months. In regard to the non-core inflation, this increased to 10.1 from 10.1 to 10.8. And the culprit for this was because of higher food prices, and in particular, tomatoes went up, Irish potatoes also went up, and I think also cabbages and sukuma wiki, all those had an acceleration of prices, and that's why the non-core inflation rose from 10.1 to 10.8%. So despite the expected upward pressure from higher energy prices, the overall inflation is expected to remain within the 5 plus or minus 2.5% target range in the near term. and this will be supported by appropriate monetary policy actions, the expected stability in food prices owing to the favorable weather conditions, and also because of the continued stability of the exchange rate. The chart here depicts the inflation outlook with and without the oil price shock. The line below showed the outlook that we had before the oil price shock, and as you can see, before the shock, inflation was expected to really remain below the 5% midpoint up to March of 2027. However, with the oil price shock, and assuming that the conflict lasts for the next 3 months, that the forecast overall inflation does go above the midpoint of 5%, peaking at 6.2% in July of 2026, and then from there it progressively declines to 5.7 by March of 2027. Having said that, this assumes that the ceasefire does not hold and that the conflict lasts until June of 2026. But in the event that the ceasefire does continue to hold, then we'd expect that line, the outlook with oil price shock, will be much lower, closer to the outlook that we had before the oil price shock. Looking at inflationary expectations from our surveys, the Market Perception Survey as well as the Agricultural Sector Survey, these surveys show that inflationary expectations remain anchored within the 5 plus minus 2.5% range in the near term, but some upward pressure is expected due to the higher oil prices. In the case of the Agricultural Sector Survey, a majority of the respondents to the February survey had expected inflation to decline or remain unchanged on account of the lower food prices due to favorable weather conditions. In fact, only about 40% expected the prices to increase in February. These expectations changed in the March survey, with most respondents expecting some upward pressure on inflation due to higher international oil prices arising from the conflict in the Middle East. And specifically now, the March survey shows that those who are surveyed in the agricultural sector, 62% expect inflation to be higher in the next 3 months. Nevertheless, inflation is expected to remain within the target range in the near term, supported by stable food prices, again owing to favorable weather conditions and the stability in the exchange rate. In regard to the Market Perception Survey, the survey of both banks and non-banks, the survey shows that inflation expectations in the near term remain anchored within the target range, again because of lower food prices and a stable exchange rate. Nevertheless, respondents expect some upward pressure on inflation due to higher international oil prices, again because of the crisis in the Middle East. So to summarize developments and outlook for inflation, the overall inflation was broadly stable at 4.4% in March of 2026, and this was compared to 4.3% in February and remained below the midpoint 5%. Despite expected upward pressure from higher energy prices, the overall inflation is expected to remain within the 5 plus or minus 2.5% target range in the near term, and this will be supported by appropriate monetary policy actions, the expected stability in food prices, and a stable exchange rate. The March 2026 MPC Market Perceptions Survey and the Agricultural Sector Survey and the CEO's survey show that inflation expectations remain well anchored within the target range in the near term, but some upward pressure is expected due to the higher energy prices. The main risk to the inflation outlook relates to heightened geopolitical risk. Again, if the conflict in the Middle East is prolonged, and also there is some risk arising from the elevated trade policy uncertainty. Turning to GDP growth developments and the outlook, the growth of the economy is projected at 5.3% in 2026, and this is compared to the previous projection of 5.5%. And this reflects the emerging risks of the conflict in the Middle East on the performance of some of the key sectors of the economy. We expect that higher energy prices are expected to affect negatively the performance of key sectors such as manufacturing, transport and storage, accommodation and food services, as well as the wholesale and retail trade sectors. The disruptions also are expected to affect the exports and imports of our goods and services. On the other hand, the agricultural sector growth is expected to improve, supported by favorable weather conditions, and the industrial sector continues to recover, driven by construction and affordable housing programs with the settlement of pending bills and also the PPPs, the private-public partnerships. So key service sectors are expected to remain resilient, supported by continued digitization of the economy, expansion of e-commerce, and the conducive macroeconomic environment. The improved uptake of credit across key sectors is also expected to support growth, particularly in manufacturing, building and construction, the agricultural and consumer durable sectors, as well as the trade sector. And as a demonstration of the expansion of credit to the private sector and to specific sectors, we can see that manufacturing credit to the manufacturing sector has started to pick up. It started off as 0.6% in January of 2026 and now has reached 4.8% in March. Credit to the trade sector remains strong, and also for the building and construction remains very strong at 30%, but also for consumer durables and agricultural sector, we see credit expansion to those sectors remaining quite strong. Looking at the surveys, the CEOs and the market perception surveys, these surveys have revealed sustained optimism about the domestic business activity and economic growth prospects for the next 12 months relative to the estimated growth in 2025. For the banks, those that were surveyed, 87% were fairly optimistic about the growth prospects in the next 12 months relative to last year. For the non-bank private firms, 70% also were optimistic about growth prospects for the next 12 months. But obviously, the optimism is slightly lower now compared to the earlier survey. In the case of the banks, there's a slight decline from 89 to 87, and also for the non-banks, a slight decline from 75 to 70. For the CEOs, we do see that in terms of expectations for the next 12 months, 22.4% expect higher growth, and 52% expect about the same level of growth, and only 25% expect growth to be lower. So this optimism was attributed to the stable macroeconomic environment with low inflation and stable exchange rate, lower interest rates, and expected favorable weather conditions, which are expected to support the agricultural sector, increased infrastructure spending, increased digital innovations, and improved credit to the private sector. Nevertheless, respondents expressed concerns about increased global uncertainties arising from the conflicts in the Middle East, high cost of doing business, and low consumer demand. So to summarize on the domestic economic growth, the growth of the economy is estimated at 5.0% in 2025. This is compared to 4.7% in the previous year, and this is mainly reflecting a rebound of the industrial sector and the resilience of the services sector. The leading indicators of economic activity point to resilient performance in the first quarter of 2026. The growth of the economy is projected at 5.3% in 2026, and this is compared to the previous projection of 5.5%, and this reduction in growth reflects the emerging risks from the conflict in the Middle East and its negative impact on the performance of some of the key sectors of the economy. The MPC surveys conducted in March of 2026 revealed sustained optimism about business activity and economic growth prospects for the next 12 months, but there are concerns about the conflict in the Middle East. This outlook is subject to risks, particularly a prolonged conflict in the Middle East and the continued elevated trade policy uncertainties. On monetary developments, the monetary policy implementation framework has continued to support stability of the Kesonia and align the Kesonia very closely to the CBR, and this has enhanced monetary policy transmission. And again, just for purposes of comparison, you can see that the purple line, which is Kesonia, and the blue line, which is the CBR, and starting from the left-hand side, you can see that there's been a convergence between those two lines, and indeed, as of March 2026, the Kesonia was at 8.748, and this is compared to the CBR rate of 8.75. So they're moving very closely and are tied together based on this new monetary policy implementation framework. So we have been easing monetary policy since August of 2024. We have indeed reduced the CBR by 425 basis points. And this easing of monetary policy has resulted in short-term interest rates, and also the commercial banks' lending rates have declined, again in line with that easing of monetary policy. On the left-hand side are the developments for the average treasury bill rates, and as you can see, for the 91-day, for the 182-day, and the 364-day treasury bills, these rates have declined quite significantly from the peaks of around early 2024. Looking at I think they were between 16% and 17%, and now as of March, they are only between 7.5% and 8.4%. On the similarly for the commercial bank interest rates, these have also declined from a peak of 17.2% to 14.66%. And also deposit rates have also declined from 11.5% to 6.86%. Again, the yield curve for government securities has shifted down significantly compared to, let's say, June 30th of 2024, which is the top red line. And the bottom black line is the yield curve as of March 30th, 2026. And you can see there's been a significant shift downward of the yield curve, and also the curve itself slopes in a normal way, showing that the monetary policy just basically reflects the easing of monetary policy that we have been implementing since the August of 2024, and that the interest rate on any of the tenors has actually come down even for the longer term bonds. So growth in commercial banks lending to the private sector has continued to improve, reflecting improved demand for credit, again in line with the lower lending rates that I just mentioned. The credit to the private sector has picked up from minus 2.9, where it was in January of 2025, and has consistently gone up and is now at 8.1% at the end of March. The revised risk-based credit pricing model was fully implemented in March of 2026, and it is now expected to improve the transmission of monetary policy decisions and also to enhance the transparency in loan pricing. So to summarize on the monetary developments, the Kesonia, the operational target for monetary policy, has continued to closely track the central bank rate. Short-term interest rates have declined further in line with the recent reductions in the CBR, and reflecting the decline in lending rates, growth in credit to the private sector has improved to 8.1% in March 2026 from 5.9% in December of 2025 and from negative 2.9% in January of 2025. Commercial banks' average lending interest rates have continued to decline, with a decline in short-term rates expected to transmit further into lower lending rates and improved lending to the private sector. We now turn to the balance of payments developments and outlook. The current account deficit is expected to widen due to the impact of the conflict in the Middle East, and that is line A. And then line B, we are projecting about $5 billion inflows, $5 billion of inflows, and that, as you can see, results in an overall balance of payment surplus of $619 million, which then goes into a build-up of international reserves. For the current account, we are expecting the current account to widen, as I just indicated, from 2.4% in 2025 to 3% in 2026. And the reason for this is a widening of the trade deficit and also lower secondary income transfers in terms of GDP. The goods exports, we had an increase in goods exports for 12 months up to February of 8.1%. However, we expect for the year as a whole exports to increase by 5.3%. And again, this deceleration reflects the impact of the conflict in the Middle East and the reduction in exports, direct exports to the Middle East, but also potentially lower exports to indirect impact of lower receipts have just declined slightly through February, but we do expect a pickup later on, and that for the whole year to increase by 2.6% for the whole year. 2.6% for the whole year. For the tourists, you had an increase of 7.2%. For the tourists, you had an increase of 7.2% through February. Again, because of the disruptions and potentially higher ticket costs, we have reduced the growth of tourists to only for the 12 months to February. We expect maybe a slight deceleration, again, because of the direct impact on remittances from the Gulf area, where about 10% of our remittances come from, but there are also potentially indirect effects arising from potentially a slowdown in other countries. For example, in the U.S., if there is a slowdown in growth in the U.S., that could have potentially have an impact on remittances from the U.S. So we are projecting a growth of remittances of only 1.4% this year. The foreign exchange reserves continue to provide an adequate cover and a buffer against short-term shocks. As of 7th of April, we had gross reserves of about $13.4 billion, which is equivalent to 5.7 months of import cover. And again, just to show, to demonstrate the buffer that is there, you can see when we look back to 2024, when our international reserves were about 10 billion. The import coverage was 4.4 months of import cover, which is sits favorably when we compare with our target, central bank target of 4%, or 4 months of import cover, and also the East African Community Convergence criteria of 4.5 months of import cover. So this is really just to demonstrate that we have enough cushion, we have enough buffer to be able to manage the foreign exchange market in a way that the exchange rate is not volatile and there is no excessive volatility in the exchange rate. And indeed, despite the heightened geopolitical risk, the Kenya shilling has remained broadly stable, supported by diversified foreign exchange inflows and increased confidence in the economy and adequate foreign exchange reserves. So again, just to summarize the balance of payments developments and outlook, we expect that the current account deficit is estimated at 2.4% of GDP in the 12 months to February of 2026, and this was higher than the 1.3% of GDP in a similar period in 2025, and this widening of the current account deficit reflects a higher trade deficit and lower secondary income transfers as a percent of GDP. The current account deficit for 2026 is projected at 3% of GDP, and this has widened compared to what we had before of 2.2%. And this is a reflection of the emerging risks of the conflict in the Middle East, and reflects the higher oil prices, lower receipts from services, slower growth in remittances, as well as slower growth in exports. The current account deficit is expected to be more than fully financed by financial account and capital inflows in 2026, and this will result. Those foreign exchange reserves are projected at $13 billion at the end of 2026 from $12.4 billion at the end of 2025. The downside risk to the balance of payments outlook are prolonged conflict in the Middle East may exacerbate commodity price disruptions, elevated trade policy uncertainty, and volatility in international oil markets arising from the Middle East conflict. Turning to the banking sector developments, the banking sector remains stable and resilient. The capital adequacy and liquidity ratios for the banking sector have remained above the minimum statutory limits of 14.5% and 20% respectively. A total capital adequacy ratio stood at 20.3% in February of 2026, and this was up from 20% in December of 2025. The average banking sector liquidity ratio was 61.7% in February of 2026, and this was up from 59.3% in December of 2025. The ratio of gross non-performing loans to gross loans stood at 15.6% in March of 2026, compared to 15.4% in December of 2025, and a high of 17.6% in August of 2025. Banks have continued to make adequate provisions for the NPLs, and the sector remains profitable, providing sufficient buffers. The revised banking sector risk-based credit pricing model was fully implemented in March of 2026 and is expected to improve the transmission of monetary policy decisions to commercial banks' lending rates and enhance transparency in the pricing of loans by commercial banks. In regard to fiscal developments and the outlook, the government's planned fiscal consolidation going forward is expected to reduce debt vulnerabilities over the medium term. The deficit under the supplementary budget that has been approved by Parliament is a deficit of 6.4 for this year, and this is expected to narrow to about 3.3% by the year 2029 and 2030. So to summarize, and some of the key takeaways, on the global front, inflation is projected to increase in 2026, driven by higher energy prices, because higher energy prices. The Kenya shilling has remained relatively stable and is expected to remain stable. Economic growth has remained resilient, anchored on macroeconomic stability, growth in credit to the private sector, and improved economic growth prospects. The monetary policy implementation framework and confidence in the economy remains strong, as reflected in sustained optimism in the economic prospects by respondents to the MPC surveys. In view of the elevated global risks, the CBK has kept the CBR unchanged to ensure that inflation expectations remain anchored and that the exchange rate remains stable. The CBK remains vigilant to any second-round effects of higher international oil prices on inflation. Thank you very much.
Thank you. That was the governor with the background data of the decision of the MPC. So we'll go straight into your questions. We begin with Ken Aseka from the Kenya Times. who asks, has the CBK observed signs of deposit flight, reduced interbank activity, or tighter lending standards due to the Iran war? And he continues with, how is the war affecting the banking sector? George Obuluta from Reuters asks for an update on the talks with the International Monetary Fund. How urgent does a Middle East conflict make it for Kenya to get a new IMF program? Peris Moshiri from Madam Economist and Vincent Mumo are asking more or less the same questions about the Kenya shilling and whether and how the war in the Middle East will affect the Kenya shilling. But Peris also asks about debt sustainability in relation to that war.
Yeah, starting with Mr. Aseka's question, whether we have observed any signs of deposit flight and reduced interbank activity. So far, we haven't seen any impact of this on the banking sector. That's not to say that there won't be any impact, but of course, first of all, it depends on how long this conflict lasts, and in addition, how will it impact on some of the sectors. We can see that potentially there could be an impact on remittances, as I said before, and that could have an impact on aggregate demand, and a slower economy could ultimately have an impact on credit risk. But so far, we have not seen any impact on the banking sector. We are in very close touch with the banks just to assess exactly how this crisis is affecting the banks. We have written to the individual banks to find out how they are coping with this risk and what measures they are taking to mitigate the risk. And we do hope that by the middle of this month, we will have the responses from the banks and really have a better and more comprehensive understanding of the impact of this crisis on the overall banking sector. On the issue of the IMF, of course, as you all know, we did have an IMF mission last month, at the beginning of last month, towards the end of February and beginning of March. We will continue those discussions in Washington later on this month, and we hope for a positive outcome. On the issue of the stability of the exchange rate, and I want to combine the question by Peris Muchiri and Mumo. I think they both have to do with the stability of of the exchange rate. As I said, we have indeed factored in. In fact, I think we've been very cautious in our projections of the balance of payments. We have taken into account much lower export growth. We have assumed a deceleration in the remittances. We have assumed tourism receipts, a lower growth in tourism receipts. And despite that, we still have, as I indicated earlier, we still have a balance of payment surplus of $619 million. I also indicated that we have a very, very large cushion, if I may put it that way. In our buffers, we have strengthened our buffers. We were waiting for this kind of shock. That is why we built up our reserves to the level where they are now. And I do believe that with that surplus and with the amount of reserves that we have, we should be able to manage volatility in the shilling dollar exchange rate going forward. On the issue of the increased domestic borrowing and the debt sustainability, Yes, I think with the revised fiscal deficit, there will be some increase in domestic borrowing. Having said that, already we have borrowed significantly for the national treasury. So even with the revised deficit, we don't see that there is going to be an acceleration of borrowing from what is the norm. And therefore, we don't expect that to have any upward pressure on domestic interest rates. Yeah.
The next set of questions, we begin with Tiato Guguyu from Orals, East Africa. And this is more to do with agriculture. As you approach the end of the March, April, May rains, which are the long rains, how badly do you expect the fertilizer shock from the Iran war to exert inflationary pressures on food prices? Kevin from Capital FM, foreign reserves have decreased significantly in the last month. Can you explain why this happened? And it's a similar question that came from Habling, so I think those can be taken together.
Yeah. I think starting with Otiato's question, we don't see much impact on the agricultural sector right now. I think most of the fertilizer had already been imported for this season, so we don't see that the fertilizer shock will have really an impact on the agricultural sector this year. Now, if it's sustained, that possibility could arise in 2027. But as far as 2026 is concerned, we don't see it having that impact, and therefore, it's our expectation that even as fuel prices go up and as transport prices also go up, our expectation is that the, as you call them, the MAM rains, which is the March, April, May rains, will be actually supportive of inflation. We expect food inflation to come down. As I indicated, what was actually driving the core inflation from 10.1 to 10.8% were some vegetable items. And I mentioned cabbages, skuma wiki, and of course tomatoes, and tomatoes as well as potatoes. And I think the good rains, the favorable weather conditions that we are experiencing and that we expect to experience in the next months will be supportive of offsetting the pressures from the fuel inflation and also from the transport inflation. On the foreign reserves, of course, the foreign reserves, the impact, the reason, part of the reduction in foreign reserves is obviously because we also pay debt service payments. So part of the reduction in these reserves is because of that. But again, I come back and say the 13 billion plus of reserves that we have is much more than sufficient. And it covers 5.7 months of import cover. So notwithstanding that decline that you have seen, we still have a fairly large cushion of reserves to be able to address any volatility that may arise either from this shock or even from another shock, because we do have enough foreign exchange reserves.
Thank you very much. Just looking at the rest of the questions, they have either been answered in the presentation or in some of the other Q&A. So I believe that brings us neatly to the end of this post-MPC briefing. So as it usually says in the statement, the MPC is going to meet again in June, but if there's any need, it will convene as necessary. But for now, thank you very much for being with us, and do see you soon.